I'm Jim Jubak, and welcome to this week's Trend of the Week video. Yield curve inverts. What does it mean? Okay, so the standard interpretation of the yield curve, that's when short-term treasuries start to yield more than long-term treasuries, is it's a sign of a recession coming. Recession means that over the longer term, yields of longer term bonds are going to fall faster. Or in this case, it means that we've seen the peak of inflation and interest rates, and that we're going to then see rates start to come down. But longer term rates come down faster in this circumstance than shorter term rates. Okay, this is the picture on Monday, November 28th. The 10-year Treasury was paying 3.71%. That's what its yield was. The 2-year Treasury, however, was paying 4.47. Normally, you get paid more to hold a Treasury for longer because you're taking on more risk. But here you're getting a good 70 basis points more for just holding the 2-year. And the 1-year was paying even more, 4.68 instead of 4.7 for the 2-year or 3.71 for the 10-year. What all that is a reflection of is the market's belief that we're going to see interest rates in the short term continue to go up. The Fed's going to raise rates a few more times. But over the longer term, rates are going to come back down. So a 10-year at 3.71 reflects the fact that we're looking at that. Now, does this really mean what it normally means? I think the answer to that is no. I don't think the market is reflecting the possibility of a recession, because the market is not looking for a recession in 2023, despite the fact that we're starting to get noise from the Fed saying, hey, maybe we're going to see unemployment rise enough so that we get a recession. I think what the market is saying is that we're looking at a peak in interest rates, and they're going to come down. The question, of course, is the market right about that? My personal opinion is no, the market happens to be wrong here. The market is overestimating how quickly rates are going to come down and underestimating how quickly rates are going to go up. I think the Fed, my estimate, my projection for a long time has been the Fed is going to need to raise its short-term benchmark rate to about 6% to clamp down on inflation. We're now at 3.75 to 4, so that's a lot more room for rate increases than the market, I think, is expecting. So yes, indeed, if the market is correct, we're looking at a inverted yield curve that says interest rates are going to come down, and we may be looking at a recession, but I'm not sure this is normal times, and I don't think the inverted yield curve means what it has meant at times in the past. Thanks very much for watching. If you like this video, please like it, give us a thumbs up, subscribe to my YouTube channel. That way you get notification when we do our next one. We're doing about 3 a week. If you want more of my stuff, including what to do about this kind of inverted rate and some ETF suggestions for that, you can go to my paid site. That's jubakam.com. Or if you want just sort of more bread and butter approach to portfolios, 3 portfolios instead of 6 on the paid site, you can go to my free site. That's jubakpicks.com. Links to those all down below. Thanks very much.